Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Welcome back to the channel, traders. Today, we're diving deep into a fascinating situation for stock that's popped up on our hard-to-borrow screener, the GrowHub Limited, trading under the ticker TGHL. We're going to break down why this technology sector stock has an annualized cost-to-borrow fee of over 700% and what that could mean for its future price action. Let's get into it. The GrowHub Limited, or TGHL, operates within the technology/software infrastructure sector. With a modest market cap of $21.01 million, TGHL positions itself as an investment holding company providing product traceability, data analytics, and product trading facilitation solutions both in Singapore and internationally. They enable organizations to track products from raw materials to final production. Show TGHL logo/chart now. Let's look at some recent price action. Today, TGHL is up a modest plus 3.23%. However, don't let that fool you. Over the last 5 days, it's down a significant minus 26.37%. But zoom out to the last 30 days, and TGHL has surged an impressive plus 82.86%, showing some serious volatility. Highlight volatility volume-wise, today we're seeing 322,000 shares traded, which is notably low compared to its 30-day average volume of nearly 10 million shares, 9,969,826 to be exact. That means its relative volume today is currently 0x average, indicating very low liquidity right now. What is cost to borrow and why it matters? So, what exactly is cost to borrow and why should you care? Show graphic. CTB explained when a short seller wants to bet against a stock, they first have to borrow shares from a broker. The cost to borrow, or CTB, is the annualized fee they pay to borrow those shares. It's essentially the interest rate on their borrowed stock. Why does it matter? A high CTB indicates strong demand for short sellers to bet against the stock, combined with a limited supply of shares available to lend. It's simple supply and demand in the stock lending market. When a CTB fee exceeds 100%, like TGHL's, it means the annual cost of holding the short position is greater than the stock's current price. This can put immense pressure on short sellers, as their cost of doing business spirals. Why this stock is hard to borrow right now. Now let's bring it back to TGHL. This stock has landed on our hard-to-borrow screener for a very specific reason, its eye-watering cost-to-borrow fee. We're seeing an annualized CTB of 773.1%. Emphasize number to put that in perspective, short sellers are paying an extraordinary premium just to maintain their bearish bets on the GrowHub Limited. The estimated float for TGHL is 12.7 million shares, but the exact number of shares currently available to borrow is unknown. This combination of extremely high fees and potentially scarce borrowable shares indicates that the market for shorting TGHL is incredibly tight. When the borrow rate is this high, it tells us that existing short positions are getting expensive to hold, and new short positions are even more so. Squeeze mechanics explained. This brings us to the potential for short squeeze. Show animation. Short squeeze process. Imagine the short seller borrows shares of TGHL and sells them, hoping to buy them back later at a low price for profit. But if the price starts to rise unexpectedly, or if the cost to borrow, like TGHL's 773.1%, becomes unbearable, the short sellers face mounting losses and expenses. If the supply of borrowable shares dries up, or if the price rises aggressively, short sellers are forced to cover their positions by buying back the shares they initially sold. This buying action creates upward price pressure, which in turn can force more short sellers to cover, creating a cascading effect of short squeeze. Our internal composite squeeze score for TGHL is currently 46.5. While not indicating an imminent explosive squeeze, it does suggest that several underlying factors are in play. However, it's crucial to remember that a high CTB does not guarantee a squeeze. It could also mean that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay these high fees to stay short. Dilution risk check. One critical factor to consider when evaluating a potential short squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can reduce the value of existing shares and, critically, can provide more shares for short sellers to borrow, effectively countering the supply squeeze needed for a short squeeze. Short text, no dilution risk for TGHL. Our recent checks are positive. We found no recent dilutive SEC filings such as -1, -3, or 424B in the last 90 days. This means that, at least for now, there isn't an immediate threat of the company itself flooding the market with new shares that could negate a short squeeze thesis. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you be watching if you're interested in TGHL? Keep a close eye on the cost to borrow fee. Any sustained increase or sudden spikes could signal growing pressure. Also, monitor the shares available to borrow. If that number drops significantly, it's a major indicator of tightening supply. Price action and volume are also key. While TGHL has been volatile, down 26.37% in 5 days, but up over 82% in 30, and today's volume is very low, a sudden surge in buying volume, especially on upward price movements, could be the catalyst. Remember, for a short squeeze to truly ignite, you often need increased buying pressure to force those short sellers out of their positions. The Grow Hub Limited, TGHL, presents an intriguing case study with its exceptionally high 773.1% annualized cost to borrow. While this doesn't guarantee a short squeeze, it certainly flags TGHL as a stock under significant short interest pressure, where maintaining bearish bets is incredibly expensive. Combine that with no immediate dilution risk, and it makes TGHL one to keep on your radar for educational purposes. As always, this information is for education only. Do your own thorough research. If you found this breakdown helpful, please smash that like button, subscribe for more deep dives into hard-to-borrow stocks, and let us know in the comments what other tickers you want us to analyze next. Thanks for watching, and we'll see you in the next video.